Fox Corporation has announced it will acquire Roku in a deal valued at $22 billion. The terms are set at $160 per share, structured as a combination of cash and Fox stock. That announcement caused an immediate 20% jump in the stock, which creates a specific dilemma for anyone holding Roku in their portfolio today. The era of treating Roku as a speculative tech growth play has reached its conclusion. From this point forward, the stock's performance is tied directly to the successful closing of the Fox merger. Success now hinges on the binary mechanics of a merger transaction. Currently, Roku is trading near $143 a share. This chart shows how that price stacks up against the $153 standalone consensus and the fixed $160 buyout offer. That $160 payout consists of $96 in cash and 0.9693 shares of Fox Class A common stock. For investors buying in today, that creates a spread of approximately $16 per share. The core decision is whether that $16 profit justifies holding your capital until the deal is expected to close in early 2027. To decide, we have to evaluate 3 distinct investment paths based on your specific timeline and risk tolerance. We can map these options on a spectrum of risk and investment duration. Path 1 is the merger arbitrager. This involves buying at the current market price and holding strictly until the deal closes in the first half of 2027. If the deal proceeds as planned, you capture an 11% yield as the trading price converges with the $160 offer. The primary trade-off is that your capital is locked for a year with no possibility of additional upside. You also take on the risk of antitrust delays, which could keep your money tied up longer than the initial 1-year estimate. This path is designed for risk-averse investors seeking a probable low double-digit return. Path 2 moves further out on the timeline, the post-merger media bull. Here, you accept the Fox stock at the closing and hold those shares for the long term. Post-merger, legacy Roku shareholders will own 27% of the combined Fox-Roku entity. This creates an extensive asset consolidation, uniting Tubi and the Roku Channel with Fox's live sports and broadcast rights. The trade-off is a shift in valuation. You are diluting a digital platform play by tying it to a legacy linear television business. You are also betting on Fox's ability to execute on $400 million in promised cost synergies. This path effectively converts a high-growth tech holding into a diversified media conglomerate investment. This leads to a critical question. What happens to the stock if regulators block the Fox deal entirely? While many acquisition targets crash when a deal breaks, Roku has developed a standalone safety net. This Q1 2026 chart shows Roku's significant financial turnaround. Total net revenue reached $1.25 billion, a 22% year-over-year increase. Driven by the platform segment, now over 90% of revenue, the company reported $86 million in net income, reaching true GAAP profitability. The scale of the platform also reached a milestone in April, surpassing 100 million active streaming households worldwide. This financial momentum acts as a buffer against their biggest standalone risk, the loss of the Walmart distribution contract. Walmart's acquisition of Vizio forces Roku to compete more aggressively in the high-cost smart TV hardware market to maintain its user growth. Despite those hardware challenges, Roku's newfound platform profitability provides a valuation floor that typical merger targets lack. Following the Q1 results and the Fox offer, Roku's role in the market has changed. Roku is distinct among merger targets because its baseline fundamentals remain strong. Programmatic ad growth and $478 million in annual free cash flow provide a protective barrier for investors. If the merger fails, this financial performance would likely support the stock price better than a typical non-profitable target. The fundamental trade-off is clear. Your downside is limited by current profits, while the Fox agreement places a hard $160 cap on your upside. Let's match your goals to this reality. For the arbitrager seeking an 11% yield, the stock is a buy. For the media investor eyeing Fox's streaming business, it's a hold or buy. But for the tech trader expecting a double, it is a pass. With the deal on the table, allocate your capital based strictly on the mathematical boundaries of that $160 ceiling.